All right, everyone, get ready, because today we're going deep into partnership expenses and taxes.
Oh, yeah.
That tricky situation where partners cover costs out of pocket.
Yeah.
And you kind of wonder, can I write this off?
It's a common question, and it makes sense.
It does.
The rules can be a bit confusing, especially when you're trying to figure out what's deductible personally versus at the partnership level.
Yeah, I mean, that's exactly why Sammy B requested this deep dive.
Oh, good.
They sent over some really interesting court cases
Yeah.
that illustrate what can go right and what can go so wrong when it comes to deducting partnership expenses.
Spectacularly wrong.
Yeah, spectacularly wrong.
Mm.
We're talking about a lawyer who tried to deduct practically everything,
Yeah.
and then a healthcare consultant whose creative bookkeeping got them in trouble with the IRS.
The IRS does not like creative bookkeeping.
No, they don't.
It's not appreciated.
So what's fascinating about these cases is they offer lessons for anyone in a partnership.
Yeah.
So whether you're a partner yourself or advising clients,
Right.
understanding these nuances can save you headaches and penalties.
Absolutely.
Okay, so let's lay down some ground rules.
Right.
What's the general rule when it comes to deducting partnership expenses on your individual tax return?
Well, generally, partners can't deduct those expenses directly on their individual returns.
Okay.
It's like double dipping.
Yeah.
The partnership already accounts for those expenses on its own return.
Right.
You can't claim that same business lunch twice, once on the partnership return and again on your own.
So one deduction per expense kind of rule.
Exactly. But of course,
There is.
there's always an exception.
Gotta love those exceptions.
And we do love exceptions.
We do.
So when can a partner deduct a partnership expense on their individual return?
Yeah. When is that allowed?
Here's the key. If the partnership agreement requires a partner to cover an expense out of pocket and the partnership doesn't reimburse them, then those expenses become deductible.
So it's not enough that the expense is just related to the partnership.
No.
There has to be that obligation in the agreement and no reimbursement.
It's about who's footing the bill.
Right.
If the agreement puts it on the partner and they don't get reimbursed,
Yeah.
then it's their personal expense and potentially deductible.
All right, so let's get into the first case study, the one with the lawyer who thought everything was deductible.
Right.
Tell me about Peter A. McLaughlin and his approach to write-offs.
So McLaughlin was a partner in a law firm,
Okay.
and he tried to deduct a whole bunch of expenses on his personal return as unreimbursed partnership expenses.
Oh, wow.
We're talking travel meals, entertainment car expenses,
Wow.
continuing education courses, even his state bar fees.
You really went for it.
He argued that it was all necessary to do his job.
So did any of it fly with the IRS?
Well, this is where that partnership agreement is so important.
Okay.
It did say that partners had to cover some indirect expenses,
Okay.
like travel and meals,
All right.
but it also said these expenses could be reimbursed by the managing partner, and the firm actually had a pretty liberal reimbursement policy.
So most of it was reimbursable.
Yeah, pretty much, and that was his downfall.
Oh.
He couldn't prove he was required to pay without reimbursement.
You just assumed?
He thought because it was related to the partnership that it was deductible.
Right.
But remember, it's not about the connection. It's about that specific obligation in the agreement.
So he skipped the reimbursement and went straight to deduct it on my taxes.
Basically. And the IRS was not amused.
No, I bet they weren't.
They love documentation.
They do.
And they love it when you follow the rules.
Yeah.
In this case, the court agreed with the IRS and denied most of his deductions. He got a big tax bill
Yeah.
and a valuable lesson about reading the fine print.
It makes you wonder how often this actually happens.
More than you think.
Yeah.
Which is why this deep dive is so important.
Right.
We're clearing up these misconceptions and giving partners the tools they need.
Absolutely. And speaking of tools, this deep dive is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple.
Simple.
iFindTaxPro.com is a platform for professionals and their clients open to everyone.
Great.
Now let's switch gears to our second case, the one with the healthcare consultant and those creative deductions.
Okay.
This one's a cautionary tale
Oh, yeah.
about what happens when you take those deductions too far.
Too far.
This is Ishveen K. Chopra,
Oh.
a consultant whose expenses raised some red flags with the IRS.
Red flags everywhere.
What kind of expenses are we talking about?
Well, she claimed some business expenses for a consulting partnership
Okay.
and tried to deduct a big medical expense, but her documentation was less than convincing.
So something's not adding up here.
Yeah.
What tipped off the IRS?
So let's start with that medical expense.
Okay.
She claimed a bunch of money for an appendectomy that was supposedly denied by her insurance, United Healthcare.
Oh,
And she gave them what looked like an invoice, but it turned out to be a little creative.
creative as in?
Creative as in made up.
Oh.
The phone number on it was only 9 digits long.
That's not how that works.
Not at all. And there was no explanation for why it was denied.
Okay.
Usually there's a reason listed,
Right.
but this one was very vague.
So red flag number 1, the phone number.
Mm-hmm.
Red flag number 2, the denial with no explanation.
Yeah.
I can see why they were suspicious.
But wait, there's more.
Oh, no.
The IRS contacted Johns Hopkins,
Okay.
where she said she had the appendectomy.
Right.
They had no record of her.
Wow.
No appendectomy, no billing records, nothing.
So that's a pretty big alarm bell. It sounds like she was playing a dangerous game.
Very dangerous.
What about the other business expenses? Were those any more legitimate?
Her attempts to prove those expenses, well, they fell apart.
Okay.
Credit card statements didn't match up, invoices looked fake, and she refused to provide key documents saying they were confidential.
Ah, the confidentiality excuse.
Class. The IRS was not fooled.
No.
The court hit her with a civil fraud penalty.
Oh, wow.
Not only were the deductions disallowed, but she faced big financial consequences.
That's a reminder that honesty is the best policy when it comes to taxes.
Couldn't agree more.
It really is, and it brings us to an important point.
Yeah.
Understand these deduction rules is key, but so is approaching taxes with integrity and accuracy.
Very important.
It's not worth messing up your finances
Right.
or your reputation trying to trick the IRS.
And even if you're not trying to be dishonest,
Yeah.
bad record keeping or just misunderstanding the rules can get you in trouble.
That's why communication with your partners and getting professional advice when you need it is so important.
You're absolutely right. Partnerships can be amazing.
They can?
But they also come with those unique tax rules
Yeah.
that need attention and accuracy.
Speaking of partnerships,
Yes.
this deep dive is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple. FindTaxPro.com is a platform for professionals and their clients open to everyone.
Great.
So let's use these cases as a starting point
Okay.
and look at some real-world examples of how these rules actually work.
Let's do it.
Are you ready to get practical?
I am. All right, so let's imagine there's this 3-doctor partnership.
Okay.
And their agreement says each doctor handles their own malpractice insurance.
Okay.
But the partnership covers the rent and utilities for the office.
All right, so each doctor covers a personal expense, the insurance,
Yeah.
and then the partnership handles those shared costs.
Right. Seems simple enough.
But that's, yeah.
But here's where it gets interesting.
Oh, boy.
Those malpractice insurance premiums, the doctors can't deduct them on their personal returns.
Wait, why not?
It's a business expense,
Yeah.
but the agreement puts it on the doctor personally,
Okay.
not the partnership as a whole.
So it's not a partnership expense then?
Right. It's all about who's responsible.
Interesting.
And let's say one of these doctors goes to a big cardiology conference. To keep up to date,
Mm-hmm.
who pays for that?
Well, it kind of depends.
Yeah.
Does the agreement say anything about professional development?
Let's say it doesn't.
Okay.
But the partnership usually reimburses for conferences that are related to their practice.
Okay.
So our cardiologist gets reimbursed.
Yeah.
Are those expenses deductible on their individual return?
I'd say no, right?
No.
Because the partnership covered the cost even though it was through a reimbursement.
You got it. But
Like
what if
when
the partnership decides not to reimburse this time?
Oh, so the doctor's stuck with a bill even though they usually cover it.
Uh-huh.
So can they deduct it now?
This is where it gets tricky.
Okay.
The rule is if you're entitled to reimbursement but don't ask for it,
Yeah.
you usually can't deduct it.
So even though they paid it personally, they could have been reimbursed.
Exactly.
It's like skipping a step.
The IRS wants to see expenses you're required to pay
Okay.
with no chance of getting that money back.
Gotcha.
It's about that obligation, not just the cost. Yeah.
Started to click now?
Good.
It's not whether it's related to the partnership.
Right.
But if they were obligated to pay it personally without reimbursement?
Exactly.
Okay.
Ready for another one?
Hit me.
Let's say there's a 2-person design firm.
Okay.
One partner finds the clients, the other does the creative work.
Okay.
The agreement says the business development partner covers travel and client entertainment,
Mm-hmm.
and the creative partner covers software and equipment.
Oh, nice. Clear responsibilities.
Right.
I like it.
So the business development partner takes a potential client to dinner.
Yeah.
They're required to handle that.
Mhm.
They keep good records, no reimbursement,
Yeah.
deductible.
Based on what we've talked about, I'd say yes.
Yes.
It meets the requirements.
But, and I can't emphasize this enough,
Yeah.
those good records are crucial.
Yes.
Without them, you're asking for trouble.
No receipts on cocktail napkins.
Exactly. Now, the creating partner needs new design software.
Okay.
The agreement says that's on them.
Deductible?
Probably yes. But software's a little different, right?
You're right. It's considered listed property,
Okay.
which means more rules.
Gotcha.
It's not enough to just show you bought it.
Yeah.
You got to prove it's used for business.
So time tracking, project logs, that kind of thing.
Exactly. Connect the dots between the expense and the work.
Okay.
And if it's also used for personal stuff.
Oh, good point.
Yeah.
You can't deduct the whole thing then.
Right. You got to figure out the percentage that's for business.
Yeah.
Which is why those records are so important.
Makes sense.
So you can accurately justify what you're claiming.
This is making so much sense. The agreement's the roadmap,
Yeah.
and the records are proof you followed it.
I like that.
All right, so back to those court cases.
Okay.
McLaughlin, the lawyer who tried to deduct it all,
Yeah.
looking closer at what he tried to deduct.
Right.
I think there's even more we can learn.
Absolutely. So remember, he claimed travel, meals, entertainment, the usual stuff. But he also tried for things like those continuing education courses.
Right.
And even his state bar fees.
Wow.
He said it was all essential for his work.
Yeah.
But the court said no.
No.
And they pointed right to that partnership agreement.
Okay.
Remember, it said those indirect expenses could be reimbursed?
Right.
That was key.
So even though he didn't get reimbursed,
Hmm.
the fact that he could have been
Yeah.
was enough to say no to the deductions.
Exactly. And plus, the firm usually did reimburse.
Yeah.
So the court basically said he probably could have gotten most of it back if he'd just asked.
He assumed instead of verifying.
Big mistake.
Yeah, big costly mistake.
It highlights something important.
Yeah.
Don't just assume something's deductible because it's related to your partnership.
Mm-hmm.
Read that agreement carefully.
Yeah.
Know how it handles expenses and reimbursements.
And if it's not clear.
Talk to the managing partner
Okay.
or a tax pro. It's always better to be safe,
It is.
especially with the IRS.
All right, so what about those car expenses McLaughlin tried to write off?
Oh, yeah, cars and taxes.
Always a fun time.
You need to prove not just the expense,
Yeah.
but that those miles were for business.
And those rules are pretty strict, right?
Yes, they are. You need proof,
Yeah.
like receipts for gas and a reason for each trip.
Oh, wow.
There's this section in the tax code, section 274D.
Yeah.
It's very specific.
Okay.
You have to keep track of everything.
Wow.
Dates, mileage, reasons for every trip.
No wonder people get tripped up.
Yeah, it's a lot.
It's not enough to just show you paid for gas. You have to connect it directly to the business.
Exactly. And McLaughlin didn't have the records. He couldn't prove the mileage, the dates, or the reasons for each trip.
So even if some were for work, he couldn't prove it.
Right. It shows you how important records are.
Yeah.
Especially for car expenses.
Right.
Mileage logs notes about each trip. Keep those receipts organized.
This deep dive is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
Great.
So what about those penalties that McLaughlin faced?
Right. So on top of denying the deductions,
Yeah.
they also upheld some penalties.
Okay.
These are to discourage taxpayers from understating their liability,
Okay.
whether it's intentional or not.
So they basically said, hey, you should have known better.
Pretty much they thought he was negligent,
Yeah.
especially since he was a lawyer.
That's a tough lesson.
It is both financially and professionally.
Yeah.
It really emphasizes why it's good to get advice from a professional.
Okay.
Even experienced people can benefit.
All right, so let's move on to our second case study,
Okay.
the one with Ishveen K. Chopra,
Yeah.
the healthcare consultant whose deductions raised all those red flags. This one really focuses on honesty and transparency in taxes.
Absolutely.
She had questionable documentation, and she even fabricated some of it.
Not good.
So let's unpack what happened.
All right.
What about that medical expense she tried to deduct?
Right. So she said she had a huge medical bill
Right.
for an appendectomy that her insurance didn't cover.
Mm-hmm.
She even gave them what looked like an invoice.
Yeah. Seems plausible.
It does. It was fake.
Yeah.
There were inconsistencies that the IRS noticed right away.
Like what?
Well, first, that phone number on the invoice,
Yeah.
it was only 9 digits.
Okay, that's impossible.
And there was no explanation for the denial.
Yeah.
That's unusual for insurance.
Yeah.
So they called Johns Hopkins,
Yeah.
where she said she had the surgery.
Uh-huh.
And guess what?
What?
They had no record of her ever being there.
Oh, wow.
No surgery, no billing, nothing.
So the whole thing was made up.
Looks like it.
That's bold.
Very bold.
So what about those other business expenses?
Right. She claimed all sorts of stuff.
Okay.
Advertising, software, equipment, professional services. But her proof was full of problems.
For example?
Well, she wouldn't give them a copy of the partnership agreement
Yeah.
or a copy of the partnership's tax return.
Yeah.
She said it was confidential.
Oh, that confidentiality excuse.
Yeah, the court wasn't buying it,
No.
especially since they needed those documents to check things out.
Right, if you're claiming deductions for a partnership,
Yeah.
transparency is important.
It is. So what else was there?
Yeah.
Well, she had an invoice for business cards and a brochure,
Okay.
supposedly for the partnership, but it was addressed to her personally
Oh, that's weird.
at her home address.
Yeah, that's not right.
And there was no proof of payment.
So no paper trail.
Nope. Then she gave them a credit card statement.
Okay.
But when the IRS called Discover,
Yeah.
they said she'd never had an account with those numbers.
Oh, wow.
So she either made it up or used someone else's account.
That's a big risk.
It is. And it happened with other expenses, too.
Oh, no.
She had invoices for computer equipment and office stuff. Yeah?
That the IRS said were fake.
Wow.
All sorts of errors, wrong information, bad formatting.
Sounds like she tried to create a paper trail.
Yeah.
But wasn't very good at it.
Not at all.
Yeah.
You shouldn't try to be tricky with the IRS.
Yeah, I agree.
And even for the receipts that were real,
Okay.
her explanations were vague.
Really?
Yeah, like she just said visited cities for conferences or on business, but no details about the events or the purpose.
So even if the costs were real,
Right.
she didn't have the proof.
No documentation, no explanation.
Yeah.
It made her look less credible.
So what about her car expenses?
Right, she said she drove a lot for the partnership.
Okay.
Like 8 long trips out of state
Wow.
for meetings and conventions.
Did she have the records?
No mileage log, no proof. She had a travel log, but it wasn't clear when it was made.
Okay.
And it didn't have the odometer readings to back it up.
So no proof of the mileage.
Right, and it didn't even have the addresses
Oh,
to
wow.
those 72 places she went. Wow, 72.
Or any details about why she went.
So lots of claims, but no real evidence.
Basically. And since she wouldn't give them the partnership's tax return,
Right.
they couldn't even check if all that travel made sense.
So incomplete records, inconsistencies, and dishonesty.
Yeah.
Was it enough for that fraud penalty?
It was, the IRS has a high bar for proving fraud.
Well,
They need strong evidence of intentional underpayment.
and in this case,
They had it.
they did.
Yeah, they showed she understated her income
Okay.
by claiming all these fake deductions.
Wow. So how do they prove she meant to do it?
They pointed to those made-up documents, her lack of cooperation with the IRS, her explanations didn't make sense,
Yeah.
and she just wasn't credible as a witness.
So it was more than just bad bookkeeping.
Yeah, it was intentional.
Wow. The court agreed and upheld that penalty.
They did. It's a serious reminder
Yeah.
that honesty is so important.
It really is. You can't game the system.
You can't. There are consequences.
So the takeaway from all this
Yep.
is that it's not just about knowing the rules.
Right.
It's about being honest and accurate.
Exactly.
Well said. We've got a lot to think about.
Me too. And remember,
Yeah.
if you have questions or you're dealing with a tax problem, getting help from a professional is always a good idea.
Yeah, definitely. Before we finish up,
Yes.
I want to remind everyone,
Okay.
if you have any questions or topics you'd like us to cover,
Yes.
just let us know. We love hearing from you. Man, these cases really make you think.
They do.
Like they're ripped from the headlines.
Yeah.
Makes you realize how important it is to get things right.
From the start.
Yeah, right from the beginning.
Absolutely. And it shows you how important that partnership agreement is.
It does, yeah.
It's the foundation.
Yeah.
The rule book for how everything works,
Right.
who pays for what, how reimbursements are handled.
It's not just about splitting the profits.
Nope.
It's about outlining those responsibilities.
Yes, especially when it comes to expenses.
Exactly. A vague agreement
Yeah.
is just asking for trouble.
Big trouble.
Confusion, disagreements between partners,
Mm-hmm.
and, as we've seen, tax nightmares.
It seems like getting a lawyer who specializes in these agreements is a good idea.
That's worth the investment.
It is. It can save you so much hassle later on.
Absolutely. So
Yeah.
beyond the agreement itself,
Yeah.
what else can partnerships learn from these cases?
Well, communication is key.
It is, yeah,
You don't want those he said, she said situations.
right. They get messy.
They do. You need transparency
Yeah,
and open communication.
absolutely.
Partners should talk about money regularly.
Yeah.
review expenses together and deal with any problems right away.
So don't just ignore things.
Right.
Or assume everyone's on the same page.
Exactly. Talking about things early on
Yeah.
can prevent small issues from becoming big ones.
Right. And of course,
Yeah.
we can't forget the golden rule.
Oh, yes.
Meticulous record keeping.
The records, those are so important.
We've talked about them a lot today.
Good reason.
And there's a reason for that.
Keep everything organized.
Yeah.
Receipts, invoices, mileage logs, all of it.
When in doubt, keep it.
Yes, you never know when you might need it.
And if those receipts are fading,
Yeah.
take a picture.
Good idea. Digital records are your friend.
They are. And if you're not sure about something,
Mm-hmm.
get advice from a tax pro.
Always a good idea.
They can help you understand the rules.
Yeah.
Make sure you're taking the right deductions
Uh-huh.
and keep you on the right side of the law.
Absolutely. It's like having a guide
It is.
in the tax jungle.
Speaking of guidance,
Yes.
let's give a shout out to our sponsor.
Right.
This deep dive is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
Great.
Okay, so remember how Sammy B had those questions
I do, yeah.
that led to this deep dive?
Mm-hmm.
They were really curious about what these cases mean
Yeah.
for people who advise partnerships,
Right.
like accountants and lawyers.
That's a great point.
It is, yeah.
It's not just the partners themselves,
Right.
it's the people who help them.
So what are the key takeaways for advisors?
Well, first, they need to understand those partnership agreements and how they affect taxes. They should be able to spot problems
Yeah.
or things that are unclear.
That could cause trouble later on.
Exactly.
Right.
So they need to read between the lines
Yeah.
and anticipate those issues.
And of course, they should stress the importance of communication and record keeping.
Always, those are crucial.
It's all about setting up those partnerships for success,
Yes.
both in how they operate and how they handle taxes.
Well said.
I think we've covered a lot today,
We have.
from the basics of deducting expenses
Mm-hmm.
to real-world examples and court cases.
Yeah.
We've really seen why clarity, communication, and good records are so important.
Absolutely. We've explored this complex area of tax law
We have.
and hopefully given our listeners the knowledge they need to approach partnership expenses the right way.
And avoid those costly mistakes.
Exactly. This deep dive is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
And remember, everyone, honesty and accuracy are the best policies when it comes to taxes.
Couldn't agree more. And don't forget,
Yeah.
if you have any questions or topics you want us to cover,
Yeah.
send them our way. We love hearing from our listeners.
Until next time, stay curious, stay informed, and stay compliant.